Hello and welcome to this session. This is Leroy Meadows and we're going to discuss today Chapter 8, dealing with flexible budgets, our continuation of discussion of flexible budgets, but now we're going to apply those to overhead costs. We're going to deal with overhead cost variance and then management control. So let's go ahead and get started here. What do we expect to do today? We expect to explain the similarities and differences in planning variable overhead costs and fixed costs, overhead costs, developing budgeted variable overhead cost rates and budgeted fixed overhead cost rates. We're going to compute the variable overhead flexible budget variance, the variable overhead efficiency variance, and the variable overhead spending variance. And then we're going to go ahead and compute the fixed overhead flexible budget variance, fixed overhead spending variance, and the fixed overhead production volume variance. Then we will talk about a variance analysis. We will explain the relationship between sales volume variance and production volume variance. We're going to calculate the variances in activity-based costing, and we'll just touch on that just a little bit. And then we'll talk about the use of overhead variances in non-manufacturing settings. Okay, so when we're planning variable and fixed overhead costs, let's talk about variable overhead costs for just a moment. When we have to plan those, we have to planning for overhead variable costs, we have to focus on activities that create a superior product service for the customers and eliminate activities that do not add value. Now, we've talked about this before in previous chapters, talking about a value-added cost and non-value-added costs. We're actually going to touch on that in a future chapter and a little bit more. But value-added costs are any of the costs incurred that increase value, whether it's real or perceived, to the customers. So additional value that is perceived or utility, any additional benefits that the customer perceives on their end. Whereas costs for products or services that do not add value, well, those costs we want to eliminate, because if we eliminate those costs and it does not change our customer's perspective of our product, then why are we incurring those extra costs? So we're planning fixed overhead costs, similar to planning variable overhead costs, only when undertaking essential activities, and then we want to be efficient in undertaking the activities. But at the same time, we have another issue: the appropriate level of capacity or investment that will benefit the company in the long run. When we talk about capacity, I know we've touched on it a few times here and there, and we're actually going to look at capacity next chapter when dealing with the different types of capacity that we can choose from. But what level of capacity? For example, with the web example in the book from chapter 7 and then this chapter also, when they make jackets, well, they need sewing machines. The number of sewing machines, when the company either purchases or leases sewing machines, the more sewing machines they have, the more capacity they have to produce jackets. How many sewing machines will I have? When we are buying or renting, even leasing equipment, those typically are longer term contracts. So we can't just for 1 week or 2 weeks say, hey, or maybe for 6 months say, hey, go ahead and take the sewing machine back. These are professional sewing machines. We can't just turn them back in like we would at a rent-a-center, turn things back in when we don't need them, and then turn around and rent them again when we do. So these are longer-term fixed costs, whether we're purchasing than the sewing machine's ours. But then if we're leasing, then we have control over that sewing machine for a period of time, and those costs are usually fixed in the longer term as well, whether we own or are leasing the asset. So let's refresh our memory on standard costing. Standard costing is a system that will trace direct cost outputs by taking standard prices or rate by the standard quantities of input allowed for actual outputs. For example, if we figure that every unit of widget we'll take two units of materials times $5 per unit of material. Then direct material costs we expect to be $10. So in that sense, those costs are standard. We should not deviate from them. We expect to pay $5 per unit of whatever material we're using, and each unit requires two, and each product, each widget that we sell requires 2 units of direct materials. Those are standard costs. And we allocate overhead costs in the standard costing system based on standard overhead cost rates times the standard quantity of the allocation basis allowed for actual outputs. For example, if we have $10,000 in overhead costs and our allocation base is $100,000 of direct labor costs that are budgeted, what is our overhead to being allocated at? Well, for every direct labor cost, we're going to allocate 10 cents of variable overhead. And if each unit requires 2 direct labor hours, or it should only require 2 direct labor hours, we're going to multiply that by the 10 cents. And so variable overhead per unit should be 20 cents. And that's going to be a standardized amount allowed for actual output. So we're going to adjust this based on the actual, for the actual output produced. But we're still only going to be 20 cents per unit. So let's go ahead here. So how do we develop variable overhead cost rates? Well, variable overhead cost rates, fixed overhead cost rates are going to be the same steps that we learned about in Chapter 4 under job costing. How do we compute overhead allocation rates? Well, first of all, we want to choose the period that we're going to be using for the budget, whether it's a month, a quarter, and remember we talked about before, the best period to be used is a year. Why? Because we smooth out seasonal production and the costs associated with that, because sometimes we're going to incur more costs in certain months than we will in others for overhead. But then that was the numerator reason. And for the denominator reason, different level of outputs per month. Some months may have higher overhead and then lower output. We produce a smaller number of units because we're not needing as many. So that's why we want to choose the period used for the budget. So remember, we want to choose, if we can, a year. We're going to find that cost driver of those costs of those overhead costs and use that as our cost allocation basis. So if the driver of our overhead cost is machine hours, then we'll choose machine hours as a cost allocation base. If the department or the units or the activity, whatever it is labor intensive, then we will use either direct labor hours or direct labor costs. Then third, we're going to identify variable overhead costs associated with each cost allocation base. So we're going to identify our cost pools. We may have one cost pool. We may have multiple cost pools. And then when we do that, we're going to compute the rate per unit of each cost allocation base. So if we have one overhead plant single wide rate, well, then we're going to have just one overhead cost rate to apply to each unit. Let's say if we're using departmental rates, and Department A uses direct labor hours, Department B uses machine hours, then we'll segregate those costs into each overhead cost allocation base. Overhead cost for Department B, overhead cost for Department A. and each department will have its own allocation of overhead. Now, fixed costs are like lump sum costs, and they don't change for a wide period of activity within the relevant range. If we remember from before, let us take, if we are going to graph this here, fixed costs would simply intersect the y-axis here and just go straight like that. We would just be a flat line. We would not and this is for actual costs. And we're talking about costs in total. And then our x-axis would be output. So here, our fixed costs stay the same in total. So they're not automatically increasing or decreasing with the level of activity as long as they're in the relevant range. Now, let's say if we have it in the relevant range, we run out and we have to add more capacity because our relevant range is changing, then we would expect it to be like a step cost function, where we have it within this relevant range, and then once I need additional output, then I incur increased additional costs, fixed costs, to accommodate that capacity. So, same thing with choosing budgeted fixed overhead rates. We're going to choose the period to be used, select the cost allocation base or the cost driver that drives those fixed costs. We're going to identify our fixed cost pools associated with each cost allocation base, and then we're going to compute the rate per unit of each cost allocation base for each cost pool. Now, when we are looking at our variable overhead cost variances, let's take a look at our flexible budget analysis. Now, our variable overhead flexible budget variance is simply going to be actual cost incurred minus the flexible budget amount. So our actual cost incurred minus our flexible budget amount, this is the same amount, or this is the same concept rather, as we did for direct materials and direct labor. Anything variable is going to simply be the actual costs incurred minus the flexible budget amount. And because this is a variable flexible budget variance, we can also break these down into variable overhead efficiency variance and the variable overhead spending variance. Now, we talked about cost as being price variances. Well, we're going to refer to variable overhead as a spending variance, but that's similar to direct material or direct labor price or cost variances. So how do we compute that? Similar way that we did for the efficiency variances, similar way as we did for direct materials and direct labor efficiency variance. The actual quantity of the variable overhead allocation base, so if our allocation base is machine hours, then we're going to take our actual quantity of machine hours minus the budgeted amount of machine hours we should have used for the actual output. And then we're going to take the difference and multiply that by a budgeted variable overhead cost per unit. And we actually look at the variable overhead and efficiency and spending variances in our example 1 exercise. That's an additional video beyond this. And then variable overhead spending variance is the actual variable overhead cost per unit of cost allocation base minus our budgeted variable overhead cost per unit. To take the difference of those and the actual quantity of variable overhead cost allocation base used. And again, we do an example of this in a different video here. With the journal entries, we're going to talk about these journal entries real quick. We incur costs, variable overhead costs, just like before, we debit variable overhead control for the amount of the costs. and then we credit the accounts payable, any type of other accounts, then wages payable, things like that. Then when we're recording actual variable costs incurred, the allocation of cost, we're going to debit work in process and credit variable overhead allocated. So in this system here with standard costing, we're still going to have two accounts for the incurrence of overhead, variable overhead control, and variable overhead allocated. And we're still going to be like in the first example here, debit variable overhead control for the amount of costs we actually incur. And then when we allocate overhead, we're going to credit variable overhead allocated. And then we're going to charge work in process for any allocation of overhead. So, and then once we, at the end of the period, we're going to close out our variable overhead allocated, variable overhead control, and then we're going to debit our variable overhead efficiency variance or credit either our variable overhead efficiency variances and spending variances depending on whether they are favorable or unfavorable. And where can we get the numbers here for our journal entries? We can get them based on that level 3 analysis here. We can do the level 2 and then do the level 3. And one thing I want to point out is don't forget that the flexible budget variance is a combination of the efficiency variance and the spending variance. So for some questions, you might be asked, what is the flexible budget variance? You may not have enough to figure out both of these numbers. Let's see. Right here and right here. But you may be able to figure it out if you're able to compute this number here and I give you this number here, then you should be able to calculate this. And once you calculate that, then you can calculate the flexible budget variance. So there's going to be a number of different ways you could be facing how to calculate flexible budget variances, so I just wanted to make you aware of that. Now, fixed overhead cost variances, it's a little bit different. The fixed overhead spending variance is going to be the same as a flexible budget variance. Why? Because those costs, as long as they're within that relevant range, should not change. So the only difference is, so that's why our flexible budget is the same as our static budget. So the only difference is with fixed overhead, there is no efficiency variance. It's only a cost or spending variance. And so the formula for, so our flexible budget, in other words, our flexible budget variance is going to be the same as our spending variance. Actual costs incurred minus the flexible budget amount. Now, since fixed overhead costs, the flexible budget for fixed overhead costs is going to be the same as our fixed overhead spending variance, and which is actual costs incurred minus flexible budget amount. Since it has no efficiency variance, it is going to have, though, a production volume variance. And that production volume variance only arises for fixed costs. We do not incur production volume variances for variable overhead costs. And this is based on the denominator level variance, and this is and the thought is based on capacity, because fixed overhead is more closely related to capacity than anything else. So, how do we get the production volume variance? Budgeted fixed overhead minus fixed overhead allocated for actual output units produced. And in example 2, we actually deal with an example of production of fixed overhead cost variances, whether it's the flexible budget and the spending variance or the production volume variance. We actually deal with that in example 2. Example 1 is for variable overhead costs. Example 2 is for fixed overhead costs. Now, fixed costs, obviously they're inflexible to some degree. Because why? Because these are long-term lease, these are long-term assets we have, and even if they're not really long-term in nature, as far as, because a lot of these years are set years in advance, and we can't really change them quickly. But some of these are maybe on a year-by-year basis, such as, a salary, personnel. If you're fixing the cost at, let's say you're paying your production manager or your supervisor $60,000 a year, then you're paying them based on working that year, not based on a per hour rate, which in some cases, if they work more, they get paid more. If they work less, they get paid less. That's an hourly worker. With salaries and management, they're given a fixed dollar amount each year. So those costs are not going to change quickly. How do we do the overhead journal entries for fixed overhead costs and variances? Same thing as with variable overhead. The actual costs incurred, we're going to debit fixed overhead control and credit what salaries payable, accumulated depreciation, etc. When we're allocating overhead, we're going to debit work in process and credit fixed overhead allocated. And then finally, we're going to close out the fixed overhead accounts by debiting fixed overhead allocated, crediting fixed overhead control, and then we will either debit or credit the spending variance and production volume variances based on whether they're favorable or unfavorable. And again, we can do this level 2 and level 3 analysis. The level 3 analysis is slightly a little bit different than what we had for variable overhead. And you will see this again in video 2. And actually in video 3, or exercise 3, we do another example of variable overhead. And this problem also includes fixed overhead as well. And then we do the journal entries for both. So we can see, and I put it in this format here, so once we do our table, we can actually see where their dollar amounts are going and then where they're being translated to the journal entries. Now, and then we see overhead here, and this is an integrated analysis, a little more where we can see it a little bit better in comparing variable manufacturing overhead and fixed manufacturing overhead. And these are good tables to look at and to really learn and to really study what's going into each unit. And again, these tables here from panel A and panel B, these follow the web company in your book. So you can always refer to your book and working through the examples there as well. Now, we have a method of presentation of all these overhead variances, or all the variances related to overhead, into a nice, neat little table in what we call the 4 variance analysis, where we have variable overhead as one line item and fixed overhead as a separate line item. And we see that it's called a 4 variance analysis. Why? Because we have variance 1, variance 2, variance 3 here, and variance 4. So we have 4 variance analysis. And again, with variable overhead, we never have a production volume variance. So that's not a variance there. And with fixed overhead, we never have an efficiency variance. So, but that is our 4 variance analysis. Now, on occasion, what you will see is just one line item for overhead, where variable overhead and fixed overhead are combined. And you might see this in a smaller group or whatever, in a smaller company. In that case, if these things are combined into one table, then we would have a 3 volume analysis, or 3 variance analysis rather. But typically we want to separate variable and fixed overhead because this is going to be based on production variable overhead, and fixed overhead is going to be based on capacity. So now let's talk about production volume variance and sales volume variance. Now, as you recall from Chapter 7, the static budget variance, difference between static budget and actual results, is the static budget variance. In our case, for a web company, was 93,100. Then we looked at the sales volume variance. That was the difference between the flexible budget amount for operating income, or any line item, as that matter, and the difference between the sales, between the flexible budget and the static budget. And remember, that shifted only based because that variance only existed because of a change in the level of sales. Remember, in the flexible budget and the master budget or the static budget, we're still basing the dollar per or the cost per unit on standardized amounts. The only difference between those two was between the different level of sales. The static budget was the anticipated level of sales, and the flexible budget was the actual level of sales. Now, the sales volume variance is going to consist of two components: the operating income volume variance and the production volume variance. So, and the easiest way to compute that is just to take our sales volume variance minus and to compute the operating income volume variance. The easiest way to do that is to, let's see, and let's just do OI variance. It's simply going to be our sales volume variance. And I'll just do that there, minus our production volume variance. And that will give us our operating income volume variance. Now, what is an operating income volume variance? You usually don't hear about that in managerial accounting. And there's really no major topic on that in cost accounting. The operating income volume variance is simply treating a fixed amount of overhead as if it behaved in a variable manner, and it takes the fixed cost per unit, and it actually is based on a fixed cost per unit overhead, fixed cost per unit, and the difference is only because, and the difference in operating income is only because of the amount of fixed costs allocated on a per unit basis times the number of units actually sold versus what we budgeted to sell. There's not that much, it's not that important to be able to calculate so if we want to calculate it, though, our operating income volume variance is just simply our sales volume variance minus our production volume variance. So, and then we see that same variance over here, right there. So now we see the overhead variance the variance analysis for the whole thing, for all the different components of manufacturing. We have our static budget variance, which is broken down to our flexible budget variance and our sales volume variance. Sales volume variance, as we just discussed, is broken down further into operating income volume variance and fixed overhead production volume variance. Right there. Now let's take a look at our flexible budget variance. These are divided into different categories here. One dealing with materials, or one dealing with selling price, the change in selling price, actual versus what our budgeted sales price was. Then for costs, we have 4 different costs associated here: direct materials, direct manufacturing labor, variable manufacturing overhead, and then fixed manufacturing overhead. And then each one of those costs are broken down into further variances to try to isolate these. Now, why do we care about isolating them? Why do we care about going all the way around here and figuring out all these variances? Why? We need to know why we have a direct materials price variance. And so when you say why, ask why, well, we want to know why. What was the reason for this total direct materials variance of $21,600 unfavorable? When we dig down into the numbers, we see that we got a better price. So that was good. We got a better price for the direct materials, but it looks like we had to use a lot more materials than we had planned. So maybe the materials weren't as good of quality. So we're not very happy about that. And then we can do the same thing here about calculating our variances. And this also will help us in the responsibility accounting to figure out who we should ask, depending on the cost being incurred, who we should ask. And what questions should we ask? Can we drill down deeper? Can we fix this? Maybe we incurred direct manufacturing labor or variable manufacturing overhead for indirect labor. Maybe some of that was due to a turnover of employees, and so we spent more time on training. Maybe it was due to we didn't have enough people. We had to pay higher skilled people to do a lower level, a lower skilled job. And maybe because of their contract, or what have you, their wages, we had to pay them a lot more than we normally would have. Let's say our normal position for labor, let's say a normal position costs $20 per hour. But if we don't have enough people to do that job, we may have to pull someone back who makes $30 an hour to do a job that we typically only pay $20 an hour for. So it could be a shortage of labor. So there's a number of different reasons why. And the thing is, we should be looking at what are the questions we could ask and how could these things have occurred. And so that's the point of the variance analysis, is to get into as much detail as we can. What occurred? How do we get this change in the static budget variance? How do we get change in the flexible budget variance and the sales volume variance? And then try to find out the root causes of these. And what you're typically going to find in a number of situations is that there's a lot of interconnectivity with these different variances. You're going to see some things that may relate to materials that also spill over and have a spillover effect to direct manufacturing labor, and then also to variable manufacturing overhead. So you're going to see a lot of interconnected variances. And that is going to be the hardest part of when we're trying to resolve the occurrences they're trying to investigate. How do all these variances relate to each other? Sometimes they may not have a direct impact. Sometimes they may. And sometimes there may be no impact. And sometimes there may be an indirect impact. So now with activity-based costing, we can do variances for activities that we do in an activity-based costing system. And we're going to do that based on activities. And for each activity, especially for the variable ones, we're going to have a flexible budget variance as we see here based on activity. And then we will also see a price and efficiency variance for those as well. What about non-manufacturing settings? Well, we can use variance analysis for those as well. For example, output measures are going to be different. Miles flown, patient days provided, rooms days occupied, ton miles of freight haul. What about other service settings, professional settings, such as, tax returns done? we can find out what's causing variances. If let's say when I'm doing taxes, it should take me X amount of time to do a return that only requires W-2s. How could I be more efficient and faster? Well, if the client only has one W-2. But what happens if a client has 7 or 8 W-2s, as I do see on a fairly regular basis year after year after year? Well, entering that data from all those W-2s, especially if there's 6 or 7 W-2s, then these clients are changing jobs every few months. So then what's happening is that it takes a lot more time to do that. So overhead variance analysis will allow us to break down and see where are we losing time, where are we gaining time, what about the labor associated, the direct labor associated with preparing those returns, how can we reduce the non-value added costs so that we're doing more with and being more efficient and being more cost effective with our services. And then overhead variances will have financial and non-financial performance measures. Financial performance measures, we're talking about dollars and cents. Non-financial measures can deal with those related to capacity utilization. How well are we utilizing capacity? And then both efficiency as far as measures of input. And when we're doing performance measures or evaluating the performance of management, we do want to utilize both financial and non-financial performance, because a lot of times management is going to be responsible not just for the numbers, but also the non-financial performance as well. How well are we managing the department, the plant, the shift, and so forth? So we can use financial and non-financial performance measures to evaluate management. So, and that ends our discussion of flexible budgets, overhead cost variances, and management control. This is Leroy Meadows. Thank you for joining me. Have a good day.